Ladies and gentlemen, good day and welcome to Awfis Space Solutions Limited Q4 and full year FY'24 Earnings Conference Call hosted by IIFL Securities Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Ramani, Chairman and Managing Director from Awfis Space Solutions Limited. Thank you, and over to you, sir.
Good morning and a very warm welcome to everyone present on the call. Along with me, I have Mr. Sumit Lakhani, our Deputy CEO, Mr. Ravi Dugar, our Chief Financial Officer, and SGA, our Investor Relation Advisors. To begin with, I'd like to thank and congratulate all our stakeholders, investment bankers, and business partners for helping us achieve a milestone of getting listed on the Indian stock exchanges. We were delighted to see such a strong response to our IPO. Since this is our maiden earnings call, I would like to take you through Awfis Space Solutions' journey so far, broad industry update and strategies going forward, followed by our operational and financial highlights for quarter and the full year ended FY'24. Post that, we will open the floor for Q&A. We have also uploaded our investor presentation on stock exchanges, and I hope everybody had a chance to go through the same. Awfis started its business in 2015 and has since emerged as one of the leading flexible workplace solutions company in India with network leadership. We identified 3 deficiencies in the Indian commercial real estate service sector, which we aim to address by offering a comprehensive range of flexible workplace solutions tailored to meet the need of our various clients, from individual freelancers to large multinational corporations. Office services include everything from individual flexible desk options to fully customized office spaces designed for startups, SMEs, and large corporates. The first aspect we focused on was transparency in pricing and tenure for office spaces. We realized that businesses often struggle with inconsistent pricing models and rigid lease terms. Office space solutions are highly adaptable, catering to diverse range of seat requirements. Clients can book anything from a single seat to multiple seats with flexible contracting periods that span from as short as 1 hour to several years. This flexibility allows Awfis to meet the dynamic and evolving need of modern businesses. Over the years, Awfis has transitioned from being merely a co-working space provider to an integrated workplace solutions platform, offering a broader array of services and solutions. The second aspect was creating more accessibility to workspace options. We understood that companies needed office spaces in a variety of locations, including diverse micro markets, to meet their unique operational needs. Therefore, we expanded our footprint to ensure that businesses could find suitable office spaces in different parts of the city, thereby enhancing their ability to operate efficiently and conveniently. The company's presence is widespread, encompassing all Tier 1 cities and 7 Tier 2 cities across India. In total, Awfis operates in 17 cities, 53 micro markets within the country. As of March 2024, Awfis has 181 centers across 17 cities, totaling 110,540 seats. The company's total chargeable area amounts to 5.56 million square feet. Currently, 21 of these centers, offering about 15,500 seats, are under fit-out. The third aspect we addressed was flexibility. We recognize that businesses require flexible workplace solutions that can adapt to their changing needs. Our model allows clients to lease spaces for varying durations from short-term to long-term, from small offices to larger workspaces. Moreover, clients have the flexibility to upscale or downsize their space as their business needs evolve. We provide 3 primary services. Our core offering is space solutions encompassing co-working solutions tailored for our clients seeking flexible workspace options available by the day, week, month, or a year, with a seat pricing structure that an enterprise solution customized for business needing tailored office setup, with fees based on service scope and client specifications. Additionally, we offer allied services like meeting rooms, day passes, ideal for temporary workspace needs, virtual office plus solution, which provide businesses location addresses and package handling services. Another service we offer is Office Transform, providing comprehensive design and build solutions for developing our centers as well as assisting in development of external commercial offices for our clients. And lastly, we have Office Care, through which we provide end-to-end property and facility management services for clients at their conventional offices. Office is the only platform across the globe which provides complete integrated services of the CRE needs with great cross-selling opportunities across our service segments. Now coming to our supply side of our business, we have a differentiated model for sourcing and procuring workspace. First, the straight lease model, and second is the managed aggregation model. Under the straight lease model, we typically enter into arrangements for a period of 5 to 9 years, and the capital expenditure for fitting out the property is entirely borne by Office. Under the straight lease model, the risk of capital occupancy buildup and pre-operative operational burn is borne by Office, turning out to be a capex-heavy model. Under the managed aggregation model, our agreements are structured on a profit or revenue sharing model, making it risk-averse, and capital of fit-outs is largely being borne by the space owner, making the whole model capital light. We typically provide a minimum guarantee to the space owner, payable generally starting anywhere from 5th to 13 months of operation until the end of term of the contract. As of March 31, 2024, the minimum guarantee at the company's managed aggregation center was at an average of 46% of that micro market rental. Over the years, we have increased our focus on lower risk, asset-light managed aggregation model, and as of March 31, 2024, 64% of our centers are in the managed aggregation model. We have increased the percentage of seats under the managed aggregation model from 46% in FY'21 to 66% in FY'24. We have the largest number of centers under the managed aggregation model among the organized workplace players as of March 31, 2024. The managed aggregation model allows for significant improvements in return ratios. Due to the increasing share of managed aggregation in our total portfolio of 181 centers, this asset-light strategy will continue to enable us to rapidly scale our business, expand our footprint, and without being subjected to any high capital investment costs. The fixed lease rental payment obligation resulting in high return on capital employed. So these two structures will help expand our capital light model and will diversify our risk. While the MA model continues to be a key part of our supply strategy, we enter into straight lease arrangements primarily when it aligns with our strategic interest or client demand is clearly identified in advance. For instance, we may enter into arrangements under SM model in prime locations where our brand presence is crucial or when a client demand is already established in a certain site or a micro market. At Office, we will continue to prioritize investments with sharp focus on return on capital employed. Let me spend a little bit of time on the industry. Our industry has witnessed accelerated demand post the pandemic. The penetration level of flexible workspace sector in the office space, non-SEZ segment, has seen a steep jump from 9% in 2020 to 12.5% in December 2023. This is expected to rise to 16% on the expanded base in 2026, which means that 1 in 6 leases across the country will be in a flexible workspace model. The demand for seats in flexible workspaces has been continuously increasing in the last 3 to 4 years and growing at an average annual growth rate of 30 to 40% from 2019 to 21. The year-on-year seat take-up is increasing at a CAGR of approximately 42% from approximately 59,000 to 69,000 seats per year in 2019 to 1,67,000 seats to 1,77,000 seats per year in 2022 and expected to reach 3,35,000 seats to 3,45,000 seats per year by 2026. IT technology and software development sectors have been the major demand drivers for flexible workspace in the last 3 to 4 years, followed by banking, financial services, and insurance, which has witnessed an increase in demand for space from flexible workspace operators over the years. In addition, according to the CBRE report, the market size of flexible workspace segment has more than tripled in last 3 to 4 years from 20 million square feet before 2019 to approximately 62 million square feet as on December 31, 2023 in Tier 1 cities, and approximately a total of 1.7 million square feet in 2019 to 5.7 million square feet as of December 31, 2023 in Tier 2 cities. The total projected market size in Tier 1 and Tier 2 cities for flexible workspace segment is projected to be approximately 105 million square feet by 2026. We recently concluded our IPO of 599 crores through a combination of fresh issue of 129 crores and an offer for sale of 471 crores by selling shareholders. We propose to utilize the net proceeds from fresh issue towards funding capital expenditure towards establishment of new centers, funding our working capital requirements, and general corporate purposes. Awfis has been a continuous recipient of awards and accolades. We received the Best Co-working Brand of the Year at Economic Times Real Estate Conclave in 2024, received the Co-working Brand of the Year award at Realty Plus Flex Spaces Conclave and Excellence Awards in 2024, received the Managed Spaces Design of the Year award at Realty Plus Flex Space Conclave and Excellence Awards in 2024. Let me conclude by saying that we strongly believe the co-working industry is at an interesting junction. With increased investment in India by MNCs, continuous growth of large corporates and SMEs, and startup ecosystem, we are confident to strengthen our leadership position in flexible workspace segment in India. Let me give you a brief on our future growth strategies. Point number 1, continue to build on industry-leading capital efficient model. This is where our managed aggregation model will come in focus because as the share of the business through MA model increases, it will have a positive impact on our return ratios and thereby on our ability to scale the business. Point number 2, expand in new and existing markets. Our approach will be to have a controlled and methodical expansion of markets. We will continue to invest in markets where we believe there are strong returns in long term. Our experience of last many years coupled with strong understanding of our client needs, we will also make strategic early investments in Tier 2 cities. Point number 3, enhance our product and service offering by applying our understanding of client needs and increasing focus on Office Transform, Office Care, and allied services. Our efforts will also be geared towards widening the range of clients we cater to. Point number 4 is to improve operational efficiency. Here we will build a strong vendor base, leverage on technological tools, and improve employee learning and development. Let me now hand over the call to Mr. Sumit Lakhani, our Deputy CEO, to share Q4 operational highlights and guidance for FY'25. Over to you, Sumit.
Thanks, Amit. Good morning, everyone, and a very warm welcome to everyone. Let me give you a quick overview on our performance. We ended FY'24 with a revenue from operations of rupees 849 crores, registering a growth of 56% on year-on-year basis. For Q4, we registered a growth of 46% on year-on-year basis and reported revenue from operations of rupees 232 crores. In FY'24, 73% of the revenues came from the co-working space on rent and allied services, 24% from construction and fit-out projects, and the balance from others. On absolute basis, for FY'24, we witnessed 48% year-on-year growth in co-working space, 95% from construction and fit-out projects, and 17% growth in rest of the business. Our revenue base is extremely diversified. Top 5 clients contributed 13.8% to space revenues, while the largest client stood at 4.9% share. Based on number of occupied seats, approximately 68% of client base belongs to large corporates or multinational companies. approximately 20% to small and medium enterprises, and 11% to startups, and the rest to freelancers. We cater to all seat cohorts ranging from a single seat to multiple seats. Our cohort of over 100 seats has been steadily increasing, and now it stands to 48% in FY24, from 50% in FY21 to 58% in FY24, demonstrating the growing confidence of our clients with larger cohorts in us. An important metric in our business is the weighted average total tenure and weighted average lock-in tenure on the basis of seat cohorts. This metric indicates the revenue visibility in our business. Currently, total weighted average tenure of the portfolio is approximately 33 months, while the total weighted average lock-in tenure is at 24 months. These two metrics are steadily increasing. Our multi-channel approach of engaging real estate brokerages, digital media, advertising strategies, and our in-house team, coupled with strategically located centers and a high-quality product, allows us to be at these healthy levels for total tenure and lock-in tenure at a portfolio level. As a commercial real estate player, occupancy levels are an important metric to assess the utilization level and plan future capex in our business. Currently, the overall or blended occupancy levels are at 71%. Within this, it is important to note that the occupancy levels increase gradually as we launch a center. For instance, 85% of the centers launched since fiscal 2022 crossed 80% occupancy within 7.5 months of starting operations. Occupancy levels for centers with more than 12 months of operation stood at 84%. This explains the strong client sourcing practices at Awfis, while also validates the selection of micro market and within micro market a specific office complex. We manage demand for our services by employing various renewal and churn management strategies. For instance, we actively monitor our renewals through our expiry 90 tool that gives us insight to forecast and monitor renewals of our clients during the next 90 days, thereby enabling us to plan efficiently in advance for vacancies at our centers. In terms of operational highlights for the quarter, operational number of centers increased from 119 in financial year 23 to 160, with an additional 21 centers under fit-outs and totaling to 181 centers in FY24. For FY23, operational seats stood at 68,203. During the year, we added 27,490 operational seats. 15,510 seats are under fit-outs, making the total seat count for FY24 at 110,540. We have also signed LOI for 16,522 seats. Overall, operational centers and seats grew by 35% and 39% respectively from FY23 to FY24. During the year, we sold 36,857 new seats, and for Q4 FY24, about 9,000 seats were sold. For FY24, 66% of seats under managed aggregation model driving capital efficiencies for the business. Average monthly churn rate stood at 1.2% for FY24. As of March 24, we served a marquee customer base of 2,459 unique clients. In terms of new openings during the quarter, 22 new centers were launched with 73% centers under managed aggregation model, and 15,084 new seats were added with 69% seats in managed aggregation model. In terms of new openings during the year, 43 new centers were launched with 79 centers under managed aggregation model, and 27,490 new seats were added with 79% seats in managed aggregation model. Overall, 86% of the supply addition was in Tier 1 cities. So, from our FY25 guidance perspective, as you can see, currently we have approximately 95,000 operational seats. We plan to add around approximately 40,000 new seats in FY25, reaching a total of approximately 135,000 seats by end of FY25. As you would have observed, that as of March 24, we already have approximately 15,500 seats under fit-outs, and for approximately 16,500 seats we have signed LOI in place, so we have good comfort of delivering this growth. The supply team is continuing to engage with space owners for new supply opportunities. Basis the supply growth and the increase in occupancy across our existing operational centers, we expect to grow our revenue by 30% in FY25. Due to an increase in occupancy and operating leverage on cost, we should be able to improve our EBITDA margins by approximately 1.5% for FY25 versus FY24. Business will continue to see higher ROCEs at level higher than FY24. This is all from my end. I now invite Ravi, our CFO, for the financial discussion.
Thank you, Sumit. Good morning, everyone, and a very warm welcome to everyone. Let me give you a quick overview on our financial performance. For FY24, our consolidated revenues from operations stood at 849 crore, a growth of 56% on a Y-on-Y basis. The EBITDA stood at 271 crores, which is a growth of 54% on a year-on-year basis. The margins stood at 31% for FY24 and at 31.5% for Q4 of FY24. The depreciation charge for financial year 24 stood at 196 crores. Out of this, rupees 55 crores was related to fixed assets depreciation, and the balance 141 crores was related to lease rentals accounting under Ind AS 116. Similarly, finance cost for financial year 24 stood at rupees 93 crores. Out of this, rupees 4 crores was related to borrowings and other finance charges, and the balance 89 crores was related to lease rentals accounting under Ind AS 116. For FY24, our cash EBIT, which is EBITDA less the actual lease payments, stood at rupees 97 crores, which is a growth of 168% on YOY basis and was rupees 36 crores in FY23. We are a PAT positive company in Q4 of FY24, and the loss of our company has reduced from rupees 47 crores to rupees 18 crores in FY24, which is a significant improvement in the performance of the company, driven by higher revenue and operating efficiencies. As you would know that Ind AS accounting EBITDA does not include rental payments. Therefore, to give a complete clarity, we are also sharing Ind AS 116 adjusted estimates. This is in a way equivalent to IGAAP accounting adjusted for lease accounting. On Ind AS 116 adjusted basis, the EBITDA has improved to 10.4% in FY24 against a 4.3% in FY23 on the back of strong revenue growth and operating efficiencies. Correspondingly, PBT has improved to 2.3% in FY24 against negative 3.9% in FY23. For Q4 of FY24, EBITDA has improved to 11.7% against a 3.2% of Q4 of last year, FY23, again on the back of a strong revenue growth and operating efficiencies. On a full year Ind AS adjusted, if we have to further do an equivalent IGAAP, Ind AS to IGAAP accounting adjustments, the impact would be around 5.8 crore, largely coming from other Ind AS adjustments, namely 109, which is on financial instruments, and 102, which is on share-based accounting payments. As a result, an equivalent to EBITDA number would be around 96.8 crore. Our debt at consolidated level stood at rupees 32 crores. Gross debt to equity is at 0.13. At the net level, we are a debt-free company and net debt to equity ratio is at minus 0.1. With IPO monies coming in and further improvement in profitability, we further expect to cement our position in the market and continue with our growth aspirations. Our ROCE stood at 43% for financial year 24, and on an annualized basis, it is at 53% for Q4 FY24. Operating cash flows for FY24 stood at 228 crores, and accordingly, OCF to EBITDA stood at 84%, which indicates a very healthy cash conversion ratio. Our CapEx spends, excluding the right of use assets of FY24, stood at 142 crores, while for FY25, we expect CapEx spends in a very similar range. This again will be a function of the mix/split between MA and SL. In our business, it is important to measure us on an annualized basis. We say this because there could be additions in capacity in specific quarters, leading to upfront investments in infrastructure, manpower due to new centers, rollout, or expansion in network, which may have a short-term impact on margins. As we have showcased our occupancy levels trend improving by end of year, we expect margins to move up and get benefit of operating leverage. Having said this, as Sumit mentioned, we are confident to deliver a margin improvement on an annualized basis of approximately 1.5% in FY'25 over FY'24. This is all from our end. We now open the floor for Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Agrawal from IIFL Securities. Please go ahead.
Yeah, thanks for the opportunity and congratulations to the entire team on the listing. My first question is on managed aggregation model. So it's a longish question. So how do you see in this 40,000 seats guidance that you have given for FY'25, is the mix of managed aggregation and SL going to be in the same 2/3, 1/3 ratio? And do you see any challenges, in terms of supply being a challenge in expanding under the managed aggregation model, especially considering, from a landlord perspective, because they need to put in the capex. And lastly, on this would be, in general, do you see the industry moving towards the managed aggregation model? You've mentioned that you're the largest player, so some color on that, considering that this is pretty ROC accretive. So your thoughts on that?
Thanks, Mohit, for the wishes, and thank you for the question. Your first question was around the split. Our endeavor would be to continue the split as we have been able to achieve, which is approximately 65 to 68% of MA, managed aggregation, and the rest being straight lease. So we'll continue in that model. Second, you said about sourcing supply. So Mohit, clearly I think it's been a journey over the last 9 years. Clearly, when we position the managed aggregation model to the landlords, it seems a bit tough to start with. But clearly now us having presence in, approximately 17 cities today, 53 micro markets. In addition, today if you look at it, out of the total 180 odd centers, almost 120 centers are in managed aggregation, and this is across tier 1 and tier 2 cities. So we have proven ourselves as, one of the best in class when it comes to partnering with our landlords and delivering returns. And we have also developed a very strong network of our both international property consultants and domestic property brokers, almost close to about 350 to 400 across India, that acts as our extended partners to help source that supply. So to answer the question in a nutshell, with the brand we have, with the credibility we have built, with the returns we have delivered to our landlords, we don't foresee any challenges. To your final question on will the other people in the industry look at it? Well, the reality today, Mohit, is that, we are the largest. We do, as I said, almost 66% of our portfolio is in MA. We are the proven entity. Will other landlords partner with other operators? I'm sure they will. But clearly, we are on this journey. Sumit outlined the growth that we have for this year, close to about 40,000 seats, out of which almost 65+% is going to be in MA model. So clearly, we have a leg up on everybody else in the industry. When you want to partner with a brand, you will go with the largest proven brand, usually in this kind of model, versus taking a bet with somebody entering new. So I hope I answered your question.
Yeah, sure. My second question is about, you mentioned in your opening remarks about making investments in tier 2 cities. So what kind of opportunity do you see there in terms of exposure? Where do you want to see, like, let's say, number of seats or revenue? What kind of opportunity do you see in the next 2 to 3 years? And what is also, if you could give some color on the kind of clients you would see there, will it be a similar mix like you have mentioned about corporate MNCs having about 68% of your demand? So would it be similar in the tier 2 markets as well?
So, Mohit, we were the first ones to expand into tier 2 cities. Our first city was Chandigarh in 2018. And we strongly believed in the growth of, the tier 2 cities. Today we are in 8 cities. 8 tier 2 cities. We will expand to a few more. We believe that the future of India from the 5 trillion to 10 trillion economy is going to be written across the 9 metro cities and, 10 or 11 tier 2 cities, of which we are already in 8. We strongly believe that, people are moving to tier 2 cities because of the demand opportunity of talent, right? It is no other reason. Clearly, if you look at, post-COVID, if you did analysis of the large ITS companies, about 65% of their talent went back to these 8 odd cities where we are already present. And we believe that many of those cities have great infrastructure, great lifestyle opportunities, and many people will probably end up staying back in those cities. And we are seeing some very, very strong demand across those cities. We also strongly believe that the demand ecosystem is going to be similar. A large portion of it is going to come from ITS or large corporates. And subset will come from, banking, finance, consulting, construction, many of those cities. And, clearly in FY'24, 14% of our cities, of our seats were launched in tier 2 cities. So we are a strong believer. We have the largest presence in tier 2 cities across the industry today. And we believe that the growth journey will continue across the 9 metro cities where we have almost 90% of our seats and tier 2 cities where we are expanding fairly quickly.
So 15% is what I heard, right? That's the number we should work with going forward as well?
Broadly, yes, Mohit. So today the portfolio split is 90-10. But if you look at Q4 of FY'24, about 14% happened in tier 2 cities. So that will move closer across the years to a 85-15 split.
Okay, understood. Thanks a lot, Amit. Those were my questions. If I have more, I'll join back to queue, but best wishes to your team for future quarters.
Thank you, Mohit.
Thank you. The next question is from the line of Viral Shah from Enam Holdings. Please go ahead.
Yeah, thank you for the opportunity and congratulations on a successful listing. I had a couple of questions. Firstly, just to clarify, Ravi did allude to this point earlier in his about the cash EBITDA. I think he was trying to state that FY'24 cash EBITDA is actually closer to 90 odd crores. Can you just help us explain this part again, just because it was not fully clear?
Yeah, hi. Thank you, Viral. So cash EBIT number for FY'24 is 97 crores to be precise. And the way we calculate the cash EBIT is EBITDA less the actual lease payments. And the reason for doing this is because, as you are aware, that under Ind AS, the lease payments are below the EBITDA line. So what we do is essentially we subtract the actual lease payments from the EBITDA to arrive at the cash EBIT for us. So that's how this number is 97 crores. Which is a growth of 168% year-on-year basis and was 36 crores last year.
Okay, sorry, this is cash EBIT or cash EBITDA?
It's cash EBIT. EBIT.
Okay.
Yeah.
Okay. The secondly was I just want to understand your strategy. It seems that you are more focused on the smaller cohorts, both on the demand as well as the supply side. Now, if I look at this seems to be at a variance with your competitors. Can you just help us understand what is the rationale behind this?
Sumit, you want to take this?
Yes. So, Viral, it's the point around the overall fundamental business model. So, let me give you a perspective from the demand side. the best way is to take an analogy of retail banking versus NBFC. Now, the advantage of a retail banking is a diversified portfolio of clients with, a lower risk. While it takes longer to build and it's more hard to build, but it's more sustainable from a long-term perspective. So we have followed a similar, approach by creating a larger number of centers so that we can attract a larger segment of users. So be it SME, mid-corporates, larger enterprises. There could be a situation where a small cohort of 25 seats could be taken by a larger enterprise as a starting point of relationship with Awfis, but that same enterprise is taking almost about 300 or 400 seats with us in some other center after experiences those 25 seats with us. Secondly, what we have seen is a smaller cohort ends up getting a better pricing realization as compared to a larger cohort. That's why we love the aspect of catering to smaller cohort. Third, it makes churn more manageable and less risk averse. So what we see is our typical center sizes of about 600 to 700 seats usually ends up having 20 to 25 different clients across various kind of cohorts. So across years, as the companies keep moving out, so it's very easy for us to manage the churn and create a more sustainable and risk averse kind of a business model. It's a tough capability to build because it requires very strong operations processes, and we're proud that we are one of the only players to deliver this capability at a scale. And I think it's a moat and a tough one for a lot of players to replicate. So that's the primary aspect on the demand side why we look at smaller cohorts. With respect to the supply side, as you would see, our center sizes are generally about 30,000 square feet, with a lot of players looking at large centers. The same logic and on the business model, we have a perspective in the size. A mid-sized center brings decent level of operating efficiencies in terms of the total operating cost. So there is no kind of loss of operating efficiency. But it's a very risk-averse scenario. We are able to build the occupancy in a span of about 7 to 9 months to about 80% of the occupancy. So it's easier to build the occupancy. Second, it's easier to manage the churn. Third, one can have a very strong kind of a larger network. So that's the reason why we have now 181 centers across 17 cities. An interesting aspect over here is if you have a larger network, the network effect from customers also come in. As you would see, almost 30% plus of our customers have taken seats with us in more than one center. So that's how a larger network with mid-sized centers as a strategy has worked out well. And our endeavor is to continue with this kind of a business model.
Perfect. Thank you, Sumit. That's all from me.
Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good morning. Thank you for the opportunity. So first question is on your margin trajectory for FY'25. So you related that you're expecting a 150 bit sort of expansion next year. So could you help us understand in Q4 what has been the exit run rate for the month of March, right? Which should give us some directional headroom. And for this margin expansion, what are the levers for this expansion to come in gradually? Yeah, that's the first question.
So, thank you, Adhidev. So for Q4, our, the EBITDA exit margin is at around 11.7. The levers for the improvement in margin, the 150 bits point what you're talking about, will largely come from the operating efficiencies and the operating leverage. So as we expand our network, we expect, efficiencies to come in further.
Okay. So if you are already at 11.7% in Q4, right? So for the full year 25, shouldn't this number be a little higher at 12% plus? It's looking at more operational efficiencies coming in as the new seats come into operation.
So we are also expanding very rapidly into new, as Amit mentioned, in a few of the new cities, and also, we're expanding in some of the new centers in the existing cities. So there will be also an impact of, new centers and the cost-related costs coming in. So what we are expecting is that, at some point of time, it will balance out with the improvement in the operating margins. and hence 1.5 is what we are taking as an improvement in the operating margin.
Okay, for the full year. Okay. Sir, then the second question, so just following on that, so then what would, on absolute terms, in the month of March, what would be the EBITDA run rate we'll be doing monthly as we have exited March 24 on a monthly basis? If you could share that number.
So then that number would be around 9.5 CR.
9.5 CR. Okay, fine.
Adjusted for all the lease, India's, 116, 102, 109 accounted for. Adjusted.
So this is the IGAP
EBITDA equivalent to an IGAP kind of a scenario.
Okay, around 9.5 crores for the month of March. Okay. So, and the second question is for the full year in 24, in your expenses, either on IGAP India, are there any one-off expenses or gains which are part of the EBITDA? If you could just clarify that, please.
So, there are no one-offs in the real sense. However, we had this, couple of, legal costs related to the selective capital reduction what we did. So, and the fundraise what we did. So, there are one-offs pertaining to that. The fundraisers and the selective capital reduction process what we went through.
Okay. And so final question is, obviously pre-IPO as of March 24, what is our net debt on books? Because there seems to be, as per the reported cash and cash equivalents, do not seem to reflect the total cash on books. So you just help us understand the net debt as of March 24.
Net debt would, so we are carrying around, so the net debt would be around -25 net of cash. So 32 is the gross sum, and the net debt is around -25 as of March.
32 crores. Okay, fine. Yeah. No, fine. That's clear. I'll come back in the queue if I have more questions. Thank you.
Sure.
Thank you. The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Good morning, sir. A couple of questions, sir. One is on pricing. So just wanted to understand when we are adding incremental seats, depending on the location, right? Like maybe the top 10, 15 locations versus the tier 2 locations. How has the pricing moved incrementally in fourth quarter, and how do you expect that to move in for FY'25, like-to-like basis?
Sumit, you want to take this?
Yeah. So, Bhavik, our pricing is a direct function of the input real estate cost. The way our financial models are built is we look at two parameters very strongly. One is the overall center EBITDA margin, which could come around. And second is the payback period. This is the kind of capital which we are investing. So these are the two primary, drivers which is driving the pricing. So within the same micro market, two buildings could have a different rental, and that's why we would have a different kind of pricing realization. So as you would see, we already have a diversified kind of portfolio on supply side with micro markets like BKC and CBD in Bangalore with higher rentals to micro markets in Calcutta which have very low rentals. So our pricing of the product on a per seat basis ranges from about 6,000 to 18,000 rupees per seat per month. We expect that we will follow a similar kind of rule and the financial metrics to determine the pricing. In any case, the way we look at as we grow into tier 2 cities, we don't see that the blended average realizations will go down because the micro market rentals of tier 2 cities are also equivalent to the micro market rentals of the peripheral places of the larger towns. So let's take an example. Let's say if we end up being in a micro market in Jaipur, the micro market rental could be also similar to the micro market rental of Navi Mumbai. So our pricing would follow the blended pricing of the whole portfolio will follow the similar trend, but we focus more on the keeping the center EBITDA margins and payback periods intact.
Sure. Just to make this simplified, when we look at FY'25 over 24, on a blended basis, you made a point that incrementally 15% of the seat addition or the outstanding would be tier 2 cities versus 10% today. So like to like, if we have to compare FY'25 over 24, the blended realizations all else equal will be like 0 to 5% higher than what they stand today, right? Like, considering all the escalations and the new additions and the mix shift, everything included, the number should be 0 to 5% higher than what it is in FY'24 overall blended, right? Is that a fair assumption?
So with respect to an existing center, a customer, so on a client contract, we already have, escalations being built in. Generally for a larger cohort, these escalations range from about 4 to 6%, and for a smaller cohort, it ranges from about 5 to 8%. So yes, from a existing center portfolio perspective, there is going to be a like-to-like increase in the overall pricing.
Understood. Second point is, Sumit, when we look at our mix today on revenues, which you highlighted 75-76% is the co-working space, and the remaining 24-25% is the transform business or the build and fit out business. Do you expect this mix to remain broadly in this range, or you think that can have that can change over the next couple of years? Like, if we look at 2-year horizon, will the mix of business revenue remain similar, or will it change?
So, from our standpoint, we offer this as a complete comprehensive solution, right? So as I mentioned in my opening remarks, that this is a, overall blended, we are a solutions platform. So clients come to us for co-working, for, doing customized solution for them, as well as for design and build, which is our office transform business. So it's an integrated offering. Now, what we feel strongly is that we'll continue to have about 75% of our business in co-working, and about similar about 20-25% in design and build. So this will continue, but we will continue to offer the comprehensive solution, so client can choose us for either taking co-working seats with us, managed office solutions, or if they take up their own space, then we can deliver a design and build solution to them.
Sure. And the transform business EBITDA margins, are we optimized, or you think there is some bit of improvement there as well? And what would that range be in today, and if it can improve, how much more can it go up to?
So currently this is about 14 to 15%, right? As you can see from our financials. We believe that as we continue with our scale, as we mentioned, we are doing 40,000 seats in our expansion for this year. In addition, obviously, this does not include the design and build business, which effectively will also translate to seats. So our buying power in the marketplace is very, very high, right? So we believe through our procurement strategy, through our efficiencies in terms of our delivery, in terms of our solutions, we will probably be able to get another 1.5% odd to this 14 to 15% margin for FY'25.
Sure. Just one last point of suggestion that I would request is, if you can give a very clear last 2-3 year pre-Ind AS P&L balance sheet cash flow, because it's very difficult to reduce the adjustment that we're trying to make, because for last 2-3 years, if you can provide that kind of data every quarter from here on, will be very important, because you yourself are looking at the business on a pre-Ind AS basis, and from an investor perspective also, that will be very helpful if you can simplify the way we report our P&L balance sheet on a pre-Ind AS basis. That's a request. Thank you.
Sure.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, congratulations on a super listing. I have a couple of questions. I just list down all my questions. Just wanted to understand the square feet breakup or the per seat kind of breakup for CAPEX in MA as well as in SL. That is my number one question. Just wanted to understand the 30 crores cash EBIT number which you reported in Q4 FY'24. Would you say this is a steady state number for the quarter, or do you think there is some operating leverage which is going to play out in FY'25 and FY'26? And what would be the tax number for the quarter if you have to include that? And I just want to understand what would be ESOP expenses for FY'25 and FY'26, since you have just listed now and we do have some ESOP pool. And I believe there was some 50 crore kind of a payout to Mr. Amani on the IPO listing. And just wanted to understand how are we going to account for that number? What would be our corporate overheads on an annualized basis? Just wanted to understand that.
I'll answer the last question that you had, and then I'll request Sumit to discuss the MA and SL split. So the number was not 50 crores, it was 5 crores to clarify. And as per the current, committee, I have completely foregone that number.
Okay.
So over to you, Sumit, on the capex part on MA versus SL.
So, Advait, with respect to the total capex which we spend on centers, we end up spending about 1,700 to 1,800 rupees per square feet on the center capex. So, irrespective of that center being under managed aggregation or straight lease model, the difference generally in capex varies from a bit site to site on the site condition. So, that's the kind of only 5 or 8% kind of variability across various kind of sites where the whole capex would vary. Then so that's the overall capex spent per square feet. Second, your question is around on the cash EBITDA basis. Can you just repeat that question on cash EBITDA?
Yeah, so we have reported on 30 crores cash EBITDA in Q4 FY'24. So is this a steady state number, or we've already guided for 1.5% margin expansion? So that I think so includes a lot of operating leverage. So this 30 crore is a steady state number, or you should see more? Is there a downside to this number, or this is a steady state number going ahead?
So, see, going ahead, the absolute basis of, the cash EBIT will also change with the, change in revenue. And for the full year, you will see a 1.5% improvement in the margins. That could be, distributed across multiple quarters. As we are giving more on an annual guidance, I'll not be able to, exactly give you a perspective whether Q1, what is, how much improvement is going to come around. But on a blended for a full year basis, we will have a 1.5% improvement.
Got it. And what would be your ESOP expenses for FY'25-26?
Okay.
So the current unamortized pool for ESOP expenses is around 6 CR between FY'25 and 26.
Okay. And the corporate overheads?
So corporate overheads, let me split that into, so essentially the corporate overheads, is comprising of the employee expenses. Now, within the employee expenses, we have two ways of, accounting for that. So the employee expenses which are at the center, at the centers what we have, that is part of the, the MA structure deal, that is part of the center EBITDA margin. So that is not in corporate, in the real sense, that's not a corporate overhead for us. The corporate overhead for that is because that the cost of that gets distributed between the landlord and us. On the other corporate overhead, which is the salary for the HO staff, is around in the range of 5 to 6%.
5 to 6% of total revenues, right?
Total revenues.
Okay, and the 30% revenue growth that you have guided is on total revenues, or is it on co-working business segment?
It is on total revenue.
Okay. Thank you so much.
Thank you. The next question is from the line of Bijal Shah from RTL Investments. Please go ahead.
Yeah, hi. Thank you for the opportunity and congratulations on listing and building a very solid business over a period of time. My question relates to competition in the segment. Now, every day in newspaper we read that there are multiple companies in the space and they are raising money also. In fact, 3 to 4 IPOs are also lined up. So how do you see competition? And in fact, in your industry report also, there are like 80 players operating in city like Bangalore and I didn't see anywhere more less than 20 players operating. So from a competitive perspective, do you see that there could be a demand-supply mismatch and which can impact pricing or occupancy over next 2-3 years?
So, as we mentioned in our opening remark, the industry is fast growing, right? By 2026, it's projected to be almost 16% of total commercial real estate, equivalent to almost 105 odd million square feet. So I think it's a sunrise sector, and I think healthy competition across the country helps provide the right solution for the customer. I think just as in real estate, there are multiple developers who coexist and do well. I think in our industry also, competitors will all coexist and do well. As far as we go, I think we clearly have differentiated ourselves, obviously being the largest when it comes to our network, 181 centers, and projection is to grow by almost 40 plus centers in FY'25. The platform approach, which we believe is very unique, which is the ability to offer somebody 1 seat to 1,000 seats. We can now design, we can build, we can maintain, we can operate, we can do all of that under one umbrella. So all commercial real estate requirements are fulfilled. Our differentiated supply model, I think we strongly believe that by having capital efficient model in our managed aggregation structure and diversifying our risk by partnering with the landlord, completely differentiates us from everybody, and we have a very, very different scale. Almost 120 odd centers out of 180 are in managed aggregation today. The size of centers matters. Sumit talked about the centers, typically about 30,000 square feet. As a result, we can have multiple locations across a city in cities like Mumbai and Bangalore. Today, we have close to about 20 plus centers in each of these cities. So kind of the size of the center matters, and obviously reduces our pre-operative burn, reduces the concentration risk. We cater to all kinds of customers, right? A large portion of India's demand is less than 100 seats. And we probably are one of the only branded players left in that space catering to that customer base. And even less than 100 seats, which is almost 50% of our demand today, it's split equally between 1 to 25, 25 to 50, and 50 to 100. So clearly we cater to SMEs, mid-corporates, large corporates, startups, freelancers, every type of customer segment in this country. And clearly when it comes to tier 2 cities, we strongly believed in it and went into expansion in those cities. Today, we strongly believe that the tier 2 strategy is a big differentiator for us and our ability to offer, kind of solutions for our customers. So I think competition is great and is healthy. We welcome all other people to come to the public markets, but we currently believe that we are extremely differentiated business, and we believe that that's the reason that we obviously will continue to grow while, mitigating, the competitive landscape.
Yeah. So just to understand, like overall at industry level, you do not see much risk of oversupply. So demand is really that strong that it can accommodate growth plans of most of the players who are there. And in fact, all of them are looking at a significant increase in their seat capacity. So you think that demand is strong enough to accommodate all the players?
Yes. See, primarily if you look at the way we are generating demand, it's a primary shift of people choosing conventional offices to moving to flex spaces. The total amount of leasing which happens every year is anyways increasing, and the percentage of flex space leasing is growing. So we are having a share because the customer preference is moving from conventional to flex spaces. So that's why there is a very large demand which couple of players are catering to. Because the business doesn't have much entry barriers as it looks like to begin with, be it like, even from a hospitality play, if you look at an example of hotels, there are a lot of branded players. There are a couple of branded players, but a lot of players in the thing. But ultimately, the larger market share is taken by the branded players. This is exactly what is happening in our industry, that the top 5 or 6 players are having a larger market share and they're growing with the network effect of the customers. So we don't, worry around on a large number of co-working players opening up in every city. Our customer base is increasing and the customer base preference is shifting from conventional office to flex office.
Okay, got it. And sir, right now, as you explained that there is impact of newer properties on margins, but eventually, say probably 2-3 years down the line, when the proportion of new property really reduces to a small number, what kind of steady state margin we can look at?
See, while we are not giving a guidance right now for the overall steady state, margins over the next couple of years, but you are right. Once, after at least for the next couple of years, we see a strong growth for the whole thing. As the percentage of existing centers versus new centers reduces, you will see a natural increase in our overall margin profile, is what I can say right now.
Okay. Sir, lastly, one request. See, I mean, it seems that the data which is available as per Ind AS is significantly different from the way you yourself analyze the business. So it would really help if you can split the employee cost into center, and if you can give center level profitability for the quarter, and then give us the corporate overheads, and also spell out exact number of rent amount and adjustment. It will really help, not only for the quarter, but probably for 2-3 years, so we can actually see the trend, as somebody also pointed out. So that would really help all the investor in better understanding a new company which is from new sectors. Thanks a lot.
Sure.
Thank you. The next question is from the line of Kunal Sharma from SP Capital. Please go ahead.
Yeah. Thanks for the opportunity, and congrats on the good set of number and the on listing as well. So, just wanted to ask on a cost front that our rental as a percentage of sales stands at nearly 21 or 22%, which has been increased from 7 to 6% over the last 3 to 4 years. So, are we entering into a higher, leasing property kind of thing over the last 2-3 years? If you could just throw some light on it, and what kind of, the rental as a percentage of sales that we are going to be maintained going forward.
Right. See, when you look at the annual number, you are looking at a blended rental value, irrespective of at a blended occupancy percentage. The way we look at the rental percentage is for the centers which have 12 months plus of occupancy, the rental percentages generally in our business for straight lease centers range about 40-odd%, and for managed aggregation business ranges about 50 to 53%. Now, as of today, if you the percentage which you are mentioning is more of a blended percentage, because there are a lot of centers which are less than 12 months old. But the general perspective, if you look at for 85% plus of stable occupancy centers, it's about 40% for straight lease and 53% for managed aggregation. So just one more point on the managed aggregation. When I say rental, it's a rental and landlord share including, because it's a variable model.
Okay, understood. Okay, so on a blended, we can say that M&A on a MA side we have a 40%, and the SL side we just have a 55% as a rental expense, right? As a percentage of
sales. So it's the other way around. Mm-hmm. MA side it's about 50 to 53% of rental and landlord share, and on SL side it is about 40%.
Mm-hmm. So are we going to maintain this kind of range or what?
See, this is the range which we have been working with over the last couple of years, and that's what we at least internally also look at trying for any kind of a center.
Okay, understood. On the second question, that we are depending 40% on brokers, right? So don't you think it could be a risk driver going forward, as those brokers must have a good amount of client-centric things, so they can be competitors going forward. If you could throw some light on particular thing.
So, see the way the overall real estate business is built, even if you look at from a commercial real estate leasing developer perspective, the brokers provide a larger kind of business. Rather, for a lot of large developers, almost about 90 to 95% of the leasing would be driven through the brokers. The way we look at our business, we are not looking at brokers as a partners, but more like a distributors and channel partners for us. The business is built in collaboration with these, consultants. What I would say is, without commenting a bit less on the competition, is the 40% dependence on brokers is probably the lowest in the industry, and by far it is best in the industry with respect to the dependence. The 60% which we are doing on our own is one of the best metrics which you would see within the overall co-working segment. And this has been built because we have built a very strong business development, account management, and a sales engine, which is the whole demand engine in-house. So from our industry perspective, it's a great metric if you would look at, a couple of, competition as well.
Okay. So we are like comfortable with this 40% as well.
Yes, we are very comfortable, and it's more of a collaborative approach where we look at them more like a partner.
Okay, understood. And lastly, last question on that. Firstly, just wanted to understand that on interior and office designing, so are we doing are we outsourcing the partners and the vendors outside, or what kind of approach there we are applying while building a new office?
Yeah. So we obviously developed this business to deliver extended services to our clients, right? From that standpoint, we built the in-house design and project management team and a very strong procurement team. So all of the design, majority of the project management, and all of the procurement happens in-house. Then we leverage our extended partners who basically do the execution at site, which would be these trades delivering interior, mechanical, electrical, plumbing systems. All the procurement of bought out items, which includes, let's say, carpet, lights, furniture, chairs, furniture, etc., is all done by us. So we hence get a lot of efficiencies there. But it is the internal team that designs and project manages the whole thing, and then an extended partner network that delivers and executes at site. Currently, we have 150 plus in-house project managers, designers, which includes our MEP designers. A lot of the team members are currently LEED certified, WELL certified, and we have exclusive tie-ups with factories for doing a lot of our loose furniture and are close to about all the modular furniture as well.
Okay, understood. Thank you so much.
Thank you. The next question is from the line of Akshay Jogani from Exponent Tribe. Please go ahead.
Hi, thank you for the opportunity and congratulations on the listing. I have a couple of questions, and pardon me if I'm repeating them because I got dropped off for a few minutes in between. When I see the DRHP, there is an illustration of your return on capital in the two different models and margins on the two different models. If you could kind of, that margin and our current margin has a reasonable gap. So I just want to understand that at what stage in the life of a center do we get to what is shown in the DRHP as an illustrative margin? And in our mix of centers, where would the mix of centers where we've already reached those economics versus where we have not? That's my question.
So, primarily, like we have mentioned in the DRHP, the ideal margin for straight lease centers for us vary between 30 to 35%. This is the center EBITDA margin. And for the managed aggregation centers, closer to about 23 to 25% is the center EBITDA margins which we look at for these centers. Now, these margins we are generally able to hit when we hit about more than 85% of stable occupancy, which we are able to hit after 9 to 12 months of occupancy of that center. Suppose that we are able to do. So within our current portfolio, as we have mentioned, almost for about 12 months plus centers, the blended occupancy is about 84%. So for a larger segment of our centers which are in greater than 12 months, we are already hitting these kind of numbers. I don't have the number of centers which are exactly hitting or meeting these kind of numbers, but you can very safely assume that a very large section of our greater than 12 months of centers are hitting these kind of numbers. As the greater than 12 months of vintage center keeps on increasing, you will start seeing the overall impact of increasing the EBITDA margins also coming up.
Sure. So, and then would it be fair to assume that, let's say 4-5 years out, right, and not right now, but when we have a significantly larger scale, the overheads from the center to eventually like the blended like total EBITDA at the corporate level the overhead would be significantly smaller, and as a result, our longer-term EBITDA margins could be 17%-18% or such numbers as sort of from the current 9, 10, 11 that we are?
See, so you are correct. Over the next couple of years, as the base for the mature centers keep on increasing, our overhead as a percentage of the total sales will keep on shrinking down, and we will hit to better kind of EBITDA margins. While I'm not giving a specific guidance of the exact percentages, but we also expect and we are working towards a very significant improvement over the next couple of years.
Sure. That's helpful. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference over to Mr. Sumit Lakhani for closing comments. Over to you, sir.
So we thank everyone for joining the call today. We hope we have been able to give you a detailed overview of our business and also answer your queries. Should you have further queries or clarifications, please feel free to reach out to SGA, our investor relation advisors. Thank you and good day.
Thank you, members of the management. On behalf of IIFL Securities Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.